Imagine for a second, you wake up tomorrow morning, you check your bank account, and sitting right there, ready to be deployed, is $1.35 trillion.
I mean, trillion with a T.
Right, with a T. Let's actually just pause and try to map that out in our heads because, human brains are famously terrible at conceptualizing numbers that large. Like a million seconds is what, about 12 days?
Yeah, roughly 12 days. And then a billion seconds is about 31 years.
31 years. But a trillion seconds, that is 31,700 years.
It's insane. It completely shatters any normal frame of reference. Like if you decided to spend $1 million every single day, it would take you roughly 2,700 years just to burn through 1 trillion.
Wow.
And we aren't even talking about a flat trillion here, right? We're talking about 1.35 trillion.
So what do you even do with that kind of capital? Buy a small continent, try to, colonize the moon of Jupiter, buy every single professional sports franchise on the planet across every league, and then still have a few $100 billion left over for snacks.
Yeah, you could easily do that.
It sounds like a ridiculous thought experiment. But today for our deep dive, we are answering that exact question. We don't have to guess or speak in hypotheticals here. We are looking at the actual real-world playbook of Blackstone, which is the world's largest alternative asset manager.
And the specific roadmap we're dissecting today is their Q2 2026 earnings conference call transcript, which, this isn't a press release designed for the public. This is where the top so CEO Steve Schwartzman, President John Gray, CFO Michael Che, they get on the phone with aggressive Wall Street analysts.
Right, the analysts who are looking for any weakness.
Exactly. They have to lay out exactly what they are seeing on the ground, what they are buying, what they are selling, and just generally how they are navigating all these massive macroeconomic currents.
So our mission for this deep dive is to act as your ultimate translators. We are going to decode the incredibly dense Wall Street jargon, pull out the most shocking insights about the global economy, and show you the exact mechanisms this financial titan is using to profit off what they're calling the biggest technological shift since the commercialization of electricity.
It's a huge claim.
It is. Okay, let's unpack this. Because an earnings call from a firm operating at this sheer scale, it's not just a report card for their own profits. This is something much, much bigger.
Oh, without a doubt. It is arguably the highest resolution crystal ball for the global economy that exists in the public domain today. When a firm manages $1.35 trillion, they aren't just participating in the market, they are foundational to it.
They are the market, essentially.
Basically, yeah. They touch every sector, every geography, every asset class imaginable. They own the vast logistics warehouses your online orders ship from. They own the data centers that are right now powering the apps on your smartphone.
The actual physical infrastructure.
Right. They finance high voltage power lines, they own hotels you vacation in, and they own enterprise software companies that run modern businesses. They just have this bird's eye view of global consumption, supply chain bottlenecks, and investment trends that, honestly, even Federal Reserve banks probably envy.
So when they tell us where the money is flowing, they are essentially telling us where the future is being built.
Exactly. They aren't guessing the weather. They are the tectonic plates creating the weather.
I love that. So before we can even begin to understand what they are buying with all this cash, we have to understand the war chest they're operating with. Let's look at the juggernaut's ledger. The headline numbers from Q2 2026 are just staggering.
Absolutely massive.
They reported GAAP net income of $2.4 billion for the quarter. But, and I noticed this in the transcript, they barely dwell on that number. The metric they obsess over, and the one Wall Street obsesses over, is distributable earnings.
Yes, DE.
That was up 26% year over year to $2 billion, which comes out to $1.52 per share. But hold on, let me stop you right there. I want to make sure everyone listening actually understands what we're talking about here. What is the fundamental difference between GAAP net income and distributable earnings?
Yeah, that is a critical distinction to make. So GAAP stands for Generally Accepted Accounting Principles. It's the standardized accounting framework mandated by the SEC.
The official rules.
Right, the official rules.
Yeah.
But in the world of massive alternative asset management and real estate, GAAP includes a massive amount of non-cash, unrealized paper gains or losses.
Paper, meaning not actual money in the bank.
Exactly. It includes things like depreciation on buildings that are actually going up in value in the real world, or mark-to-market adjustments on long-term private investments.
Okay, let me translate that into a household analogy just to see if I have the mechanism right. Think of GAAP net income, like calculating your personal net worth on paper.
Yeah.
Let's say you own a house, and the housing market in your neighborhood just surges.
Okay.
Zillow says your house went up in value by $100,000 this year. Under GAAP-style logic, you made $100,000. But you can't go to the grocery store and buy a carton of eggs with that Zillow estimate. It's totally trapped equity.
That is a phenomenal analogy, yes. Distributable earnings, on the other hand, is your actual paycheck. It's the cold, hard cash hitting your checking account every 2 weeks that you can actually spend.
So it's real cash.
Exactly. Distributable earnings, or DE, strips out all that paper noise. It represents the actual realized cash profits the firm generated during that specific quarter, cash that can legally and practically be distributed to their shareholders as dividends.
So when Blackstone reports a 26% jump in DE, they aren't talking about paper markups.
No, not at all. They are saying their actual cash-generating engine is running incredibly hot.
Because cash is reality. And speaking of cash coming in the door, the transcript notes they brought in nearly $70 billion of new capital in just this one single quarter.
That number is just wild to me. $70 billion handed to them in 3 months. That is what pushed their total assets under management, their AUM, to that record-breaking $1.35 trillion we talked about, which is an 11% increase from the year before. Again, just to ground that scale, $1.35 trillion is roughly equivalent to the entire gross domestic product of a country like Mexico or Australia or Spain. And how they extract revenue from that massive pile of national GDP-sized assets gives us a really crucial insight into the velocity of the global economy.
Right, the fees.
Right. Their fee-related earnings, or FRE, hit $1.8 billion. Total fee revenues were up 22% to $3 billion. But you really have to look under the hood of those fees to see the true story.
What do you mean?
Well, there's a massive structural difference between their base management fees and their transaction or advisory fees.
Okay, well, base management fees are pretty straightforward, right? You give Blackstone your money, they charge you a steady, predictable percentage, say 1 or 1.5% every single year just to manage it. The transcript notes, those base fees grew at a solid mid-single-digit rate. It's the bedrock. It's a recurring revenue.
Exactly.
But the transaction and advisory fees, those nearly doubled in the second quarter. Why does that specific doubling matter to the listener?
Because transaction fees are only generated when a firm actively executes a maneuver. They get paid these fees when they buy a massive company, when they sell an asset, or when they structure and syndicate a multi-billion-dollar private loan.
So it's about action.
Yes, if base management fees are the steady hum of an engine idling, transaction fees are the tachometer suddenly redlining. The fact that these fees doubled tells us that the velocity of their deal-making is accelerating dramatically. They are actively moving billions around the chessboard at a blistering pace.
They are on the hunt. And they have the ammunition locked and loaded to do it. CFO Michael Che mentioned a term that really caught my eye. He said they have $84 billion in dry powder sitting just in their credit business alone. He literally called it a coiled spring waiting to be deployed.
A coiled spring, yeah.
But let's clarify the mechanics of dry powder. Is Blackstone just sitting on a giant checking account with $84 billion in it, just losing value to inflation?
No, and that's a super common misconception. Dry powder does not mean cash sitting in a bank vault. It represents committed capital.
Committed capital, okay.
Right. It means massive institutional investors like pension funds, sovereign wealth funds have signed legally binding contracts saying, Blackstone, we pledge to give you this money the exact moment you find a good investment.
Oh, I see.
So Blackstone isn't paying interest on it, and the investors haven't actually handed the cash over yet. But the moment Blackstone finds a target, they issue what's called a capital call, and those investors are legally obligated to wire the funds within days.
So it's an invisible war chest. Having $84 billion on standby in just one single division gives them this unparalleled, almost predatory advantage.
Oh, totally.
Like if a massive tech conglomerate suddenly needs a $10 billion loan to build a factory and they need the guarantee of that money tomorrow, traditional banks might take months to syndicate that risk. But Blackstone can just make the capital call and write the check.
Precisely. They are one of the only phone calls a company can make when they need instant industrial scale capital.
So we've firmly established the scale here. They have a war chest that rivals sovereign nations, their cash flows up 26%, and the velocity of their deal making is speeding up. The most urgent question for anyone trying to understand the future of the economy is, well, where exactly is this mountain of capital going?
Right. What are they buying?
And reading through this transcript, they are not spraying and praying. It is not a diversified scattershot approach at all. The capital is being funneled into one concentrated, massive mega trend.
It dominates the entire earnings call. CEO Steve Schwartzman explicitly states that the single most significant driver of their results and their future strategy is large-scale investment in artificial intelligence infrastructure.
But wait, when the average listener thinks about investing in AI, they probably think about opening their brokerage app and buying stock in Microsoft or NVIDIA, or maybe trying to angel invest in the next hot software startup coming out of San Francisco.
Sure, the software side.
Right. But that is completely ignoring the physical reality of AI. Blackstone is taking a much grittier angle.
They are executing the classic picks and shovels strategy, but on a scale we have literally never seen before.
Everyone loves the Levi's jeans analogy for the 1849 California gold rush, right? Thousands of prospectors went out west to dig for gold, and most of them went bankrupt. The people who made guaranteed fortunes were the merchants selling the picks, the shovels, the tents, and the durable blue jeans to the miners. But looking at these numbers, Blackstone isn't just selling jeans. They are buying the literal mountain, paving the only toll road leading to the gold mines, and charging every single prospector a fortune just to get their carts up the hill.
That is a much more accurate metaphor for what they are doing. Blackstone is looking at the AI landscape and realizing they don't necessarily need to pick the single software winner.
Right.
Like, will OpenAI win? Will Anthropic win? Will Google's Gemini dominate? From Blackstone's perspective, it almost doesn't matter, because no matter who wins the AI software wars, every single one of those foundational models is going to require an unimaginable, historically unprecedented amount of physical computing power, data storage, and electricity to train and run.
Let's look at the specific partnerships they announced in just this one quarter to prove that exact point. First, they announced an initial $5 billion investment with Google to build a new AI cloud provider. They're calling it a NeoCloud. And it's going to be powered entirely by Google's proprietary TPU chips.
A massive bet.
Huge. Second, they partnered with Anthropic to form a company called Ode, which is an enterprise adoption platform designed to help massive, slow-moving corporations actually integrate frontier AI into their daily workflows.
Right.
But the third partnership, the third one, is the one that forces you to reread the transcript just to make sure you didn't misread a decimal point.
You are referring to the Broadcom partnership.
Yes.
Blackstone joined forces with Broadcom to create a $35 billion credit platform. Let me just repeat that for everyone. $35 billion. It represents the largest private credit investment in the history of the financial markets.
History. And the stated goal of that massive $35 billion platform is to deliver, quote, 1 gigawatt of compute for Broadcom's end customers. I really need to stop right here and challenge this, because I think a lot of people hear words like gigawatt and their eyes just glaze over.
Sounds like sci-fi.
Yeah. It does. My mind immediately goes to Doc Brown and Back to the Future, frantically trying to harness 1.21 gigawatts of lightning to time travel. What does a gigawatt of compute actually mean in physical, mechanical terms?
It's crucial we break this down, because we are dealing with a totally new paradigm of infrastructure engineering here. Let's start with a baseline. Think about a traditional large data center that currently powers your email, your Netflix streaming, and your company's basic cloud storage. A massive facility like that might require 20 to maybe 50 megawatts of continuous power.
Okay, so 50 megawatts is a big traditional server farm.
Right. A gigawatt is 1,000 megawatts.
Oh.
So we are talking about a single computing platform, a single concentrated node of infrastructure that draws 20 times the power of a massive traditional data center. 1 gigawatt of continuous electricity is roughly the amount needed to power a mid-sized American city. We are talking about the energy consumption of 750,000 to 1 million homes.
Just to run computer chips.
Yes, just the chips. Because the AI models being trained today, these large language models do not function like traditional software.
So?
Well, traditional software sits idle until you ask it to do something. Training an LLM requires stringing together tens of thousands of specialized, incredibly power-hungry GPUs and running them at maximum capacity simultaneously 24 hours a day for 6 to 9 months straight.
That's wild.
The thermal dynamics, like the sheer heat they generate and the electricity they draw, require an industrial footprint that looks less like a server room and a lot more like an aluminum smelting plant or a heavy steel mill.
So to build a gigawatt data center, you aren't just pouring concrete and plugging in a few servers. You have to essentially build a dedicated power plant, or at least a massive custom high voltage electrical substation.
Exactly.
You have to lay miles of specialized fiber optics. You have to source incredibly complex industrial transformers, which, by the way, I've read currently have a supply chain backlog of like 3 to 4 years.
They do. And that perfectly highlights why a company like Broadcom, which is one of the most sophisticated networking and semiconductor technology companies on Earth, needs a partner like Blackstone.
Why not just do it themselves?
Because Broadcom knows how to design the silicon. But navigating the geopolitical supply chain of industrial transformers, securing the real estate, financing the multi-billion-dollar construction over 5 years before a single dollar of revenue is generated, that requires a totally different kind of structural financial muscle.
Which naturally leads us to their fourth major announcement in this space, and this is where they start bringing this macro trend down to the public markets. They launched a new Blackstone REIT, or Real Estate Investment Trust, under the ticker BXDC.
Yep, BXDC.
They raised $2 billion for this and called it the largest blind pool REIT IPO in history. Let's translate the jargon for the listener. What exactly is the mechanism of a blind pool REIT?
A blind pool structure means that when investors hand their money over to Blackstone, Blackstone hasn't actually bought the specific properties yet. The pool of assets is, quote, blind.
So you don't know what you're buying.
Exactly. As an investor, you aren't buying a known list of 10 specific buildings in Virginia. You are writing a check based entirely on your trust in Blackstone's historical track record and their explicitly stated investment mandate.
And the specific mandate for BXDC is to acquire stabilized, newly constructed data centers. So Blackstone is essentially taking the physical homes of the internet and artificial intelligence, packaging them up into a real estate fund, and allowing public market investors to buy shares of it.
That's the playbook.
It's exactly what private equity did in the 1980s and 90s when they packaged up suburban shopping malls, or in the 2010s with apartment buildings. Now, the prime real estate isn't a mall. It's a windowless concrete box filled with flashing lights.
That is the exact mechanism. Schwartzman noted on the call that the market for long-term ownership of these stabilized data centers is essentially nascent today. It barely exists in a mature form.
Right.
But their internal projections estimate this specific subsector of real estate could grow to a $1 trillion market over time.
$1 trillion real estate market just for the concrete shells holding the servers. It's mind-bending. But diving into the physical reality of these gigawatt structures brings up a massive, unavoidable physical roadblock.
The power.
Yes, the power. You cannot have artificial intelligence without data centers, but you absolutely cannot have data centers without massive, continuous, highly reliable baseload electricity. And this connects directly into the next major theme of the transcript, the hidden bottleneck.
This is where the entire narrative of the AI revolution shifts away from the digital world of software engineers in Silicon Valley and slams face first into the gritty, physical world of concrete, copper wire, and power grids.
It gets real very fast.
Very real. Compute is no longer just a digital concept. It is now a scarce physical resource. John Gray, the president of Blackstone, stated explicitly on the call that there is a global shortage of compute. And he wasn't just talking about a temporary shortage of NVIDIA chips.
Right, because eventually the foundries in Taiwan will pump out enough chips. The real shortage is what you plug the chips into. The transcript highlights that Blackstone made a $5.3 billion investment in a company called Williams, which is a leading energy infrastructure and natural gas pipeline company.
Yes.
And the explicitly stated reason for dropping $5.3 billion into energy pipelines to support development projects that will power their data centers.
Let's look at the compounding math of this bottleneck because it's wild. Look at the valuation of Blackstone's own data center platform, QTS. 6 months prior to this earnings call, Blackstone valued their data center portfolio at $130 billion.
Okay.
In this Q2 call, they announced the valuation had soared to $185 billion in total value, which includes facilities currently under construction.
That is a $55 billion jump in total value in exactly 6 months. That kind of equity appreciation is almost violently fast.
It really is.
And the mechanism driving that valuation up isn't just that they built more buildings, it's that the barriers to entry for anyone else trying to build those buildings have become nearly insurmountable.
Exactly. John Gray walked the analysts through the gauntlet of building one of these massive AI data centers today. It is profoundly difficult. First, you have to get into the interconnection queue of the regional power grid.
Which takes time.
A lot of time. In many parts of the United States, utility companies are telling developers, we simply do not have the generation capacity or the transmission lines to give you a gigawatt of power. You will have to wait until 2030 or 2032 before we can even connect you to the grid.
And even if you can find the power, you have to get the zoning entitlements. If you go to a local municipality and say, hi, I'd like to build a massive industrial facility that will consume the same amount of power and water as your entire city, but it will only employ about 50 security guards and technicians.
They'll laugh you right out of the room.
The city council is going to say absolutely not.
Precisely. Because of those severe physical bottlenecks, the power grid constraints, and the local zoning friction, the supply of new data centers simply cannot scale fast enough to match the surging, desperate demand from the tech companies.
Which means the price of existing supply goes parabolic. But I need to jump in here and play devil's advocate. Let me push back hard on this.
Sure, go for it.
Because when I hear about total asset values jumping $55 billion in 6 months, and I see every single company on Wall Street throwing billions of dollars at a single trend, my internal alarm bells start ringing.
I don't blame you.
Aren't we practically guaranteeing a massive oversupply crash? I mean, think about the condo developers in Miami in 2006 and 2007.
Housing bubble.
Right. Everyone saw prices going up. Everyone got cheap loans. Everyone built high rises simultaneously on speculation. And suddenly there were 10,000 empty condos. The demand evaporated and the market imploded. Why isn't this gigawatt build out just a massive AI data center bubble that's going to end with empty concrete warehouses?
It is the absolute most important question an investor can ask right now. And one of the analysts essentially cornered John Gray with a variation of that exact question during the Q&A portion of the call.
Oh, really? How did he respond?
Gray's rebuttal was fascinating because it relied entirely on the structural finance mechanisms of how these deals are actually put together. He argued that the data center boom is structurally insulated from that Miami condo effect.
Defend that. How is it structurally different?
Because the Miami condo developer was engaged in speculative building. They took out a loan, built a tower, and simply hoped that buyers would show up once the paint dried.
Right.
You cannot spec build a gigawatt data center. The capital requirements are too astronomical. Instead, these facilities are highly customized to the exact specifications of the tenant. Furthermore, before a single shovel hits the dirt, these facilities are almost entirely pre-leased on ironclad 15 to 20-year contracts.
Okay, but let me interrupt. Sure, they have a 15-year lease. But if we are in an AI software bubble, and the tech company that signed that lease realizes their AI model is a failure and they go bankrupt, that ironclad lease is just worthless paper, right?
Well,
the physical real estate still sits empty, and the developer defaults on their loans.
that is where the credit quality of the tenant comes in. The entity signing these 15-year leases aren't scrappy, unproven startups running on venture capital fumes. They are the hyperscalers.
The big guys.
The Amazons, the Googles, the Microsofts. We were talking about companies with trillion-dollar market caps, tens of billions of dollars in free cash flow, and pristine fortress-like balance sheets.
Right, okay.
When Microsoft signs a 20-year lease, their corporate parent guarantee is on the line. Even if a specific AI product fails, Microsoft isn't going bankrupt. The credit risk is nearly zero. You are essentially underwriting the sovereign credit of big tech. I see the mechanism now. The developer goes to the bank and says, I need $5 billion to build this. The bank says, no way, that's too risky. The developer slides a 20-year lease signed by Google across the table.
And the bank immediately funds the loan.
Because the collateral isn't just the building, it's Google's balance sheet.
Exactly. And because of the massive physical bottlenecks, we discussed the power queues, the transformer shortages, the permits, you simply cannot have random speculative developers flooding the market with oversupply. The barrier to entry is an impenetrable wall.
It's a closed system.
Completely. Gray noted on the call that Blackstone has already secured 15 gigawatts of sites globally where they already have the entitlements and the guaranteed access to power. He stated those specific sites can support $200 billion worth of future data center development.
Wow.
That pre-approved pipeline is the ultimate competitive moat. No one can easily replicate it. It's an infrastructure monopoly in the making. But, it's not just about the raw financial engineering. There is a huge societal and environmental impact here. And Schwartzman actually dedicated a significant portion of his opening remarks to addressing it.
He did, yes.
When you are building infrastructure that draws this much power, you are essentially competing with local citizens for their own resources. Communities are going to push back, and we are already seeing legislation proposed to block data centers in several states.
Management was incredibly deliberate in addressing this friction. Schwartzman highlighted their proactive focus on the societal implications of AI. He mentioned his own 2018 donation to MIT to establish the College of Computing, which focuses heavily on the ethics and safety of artificial intelligence.
Right. But zooming in on a localized operational level, he talked about how Blackstone mandates their portfolio companies to address community impacts directly.
Yes, very specific local initiatives.
He talked about prioritizing union job creation for the construction phases, funding local workforce training programs, and investing in expanding local power generation so they aren't just siphoning electricity from residential grids. But the detail that really fascinated me was his explicit mention of utilizing water-free cooling systems for these massive data centers.
You really have to understand the physics of cooling to realize why that is such a critical public relations and environmental necessity.
I was going to say, you can't just drop the phrase water-free cooling and move on. If a gigawatt data center generates the concentrated thermal heat of a blast furnace, and they aren't using millions of gallons of water to cool it, where exactly does the heat go? How does that physics actually work?
So traditional data centers rely heavily on evaporative cooling. They use massive cooling towers where hot water from the server rooms is exposed to outside air, and as the water evaporates, it carries the heat away.
Which works, but
it's highly effective, but it is incredibly consumptive. A large traditional facility can consume millions of gallons of potable local water every single month. Obviously, if you try to build one of these in a drought-prone area like Arizona or Nevada, the local municipality will shut you down immediately.
Because you are literally evaporating their drinking water to train a chatbot.
Exactly. So the transition to water-free cooling is paramount. What Schwartzman is referring to involves closed-loop liquid-to-air heat exchangers.
Okay, how does that work?
Instead of evaporating water, they use specialized refrigerant or dielectric fluids pumped directly to the server racks. The fluid absorbs the heat, runs through a closed-loop piping system to massive radiators on the roof, and giant fans blow outside air over the radiators to cool the fluid before it cycles back down.
Oh, like a car radiator.
It's essentially the same thermodynamic principle as the radiator in your car. It consumes zero net water, though it does trade off by requiring more electricity to run the massive fans.
So they accept a slightly higher electricity bill in exchange for not alienating the local water authority, which is the only way they secure the zoning permit in the first place.
Spot on.
That is the kind of hidden operational mechanism that allows a firm to deploy billions of dollars while competitors get tied up in local city council lawsuits. Okay, let's totally shift gears here.
Sounds good.
Up until now, we have been talking in the stratosphere. Multi-billion-dollar institutional M&A, sovereign wealth funds, the biggest tech companies on Earth, thermodynamics. But we need to bring this down to earth for a minute.
To the everyday investor.
Right. We need to talk about the person listening to this deep dive right now. How is Blackstone trying to get into the pockets of everyday retail investors? This brings us to the next major segment of the transcript, the wealth channel and the democratizing of private equity.
We are witnessing a major generational structural shift in the financial world right now. Historically, the private markets were a walled garden.
Very exclusive.
Extremely. If you wanted access to the high, uncorrelated returns of private equity buyouts, private credit, or institutional private real estate, you had to be an institutional giant, like a state pension fund, a university endowment, or an ultra-high net worth family office. You needed to write a check for tens of millions of dollars just to get past the receptionist.
Yeah, to be a billionaire, to invest like a billionaire. But that door is suddenly opening to the mass affluent.
It is swinging wide open, and Blackstone has been the primary architect of what they internally call the wealth channel. They've spent the last decade designing complex financial products tailored specifically for individual retail investors.
And the growth is huge.
The growth they reported on this call is staggering. Even amidst massive geopolitical turbulence, high interest rates, and stock market volatility, their wealth channel assets under management grew 16% year over year to a record $324 billion.
$324 billion aggregated just from individual wealth investors. That is a massive, systemically important business all on its own.
It really is.
And to pour gasoline on this fire, they announced some huge new structural alliances in this quarter. They teamed up with Wellington Management and Vanguard. Now, if you are an everyday investor, you know Vanguard. They are the absolute kings of the low-cost index fund. They are the ultimate trusted retail investing brand.
Partnering with Vanguard and Wellington to launch these new all-privates and all-markets funds is a brilliant strategic move by Blackstone. It solves the biggest hurdle in retail private equity, which is complexity.
It's too complicated normally.
Exactly. Previously, if a moderately wealthy individual wanted to invest in private credit, their financial advisor had to walk them through a 300-page prospectus, explain capital calls, explain K-1 tax forms, and manually allocate the funds. It was clunky.
So what does the Vanguard partnership actually do mechanically?
It creates a seamless, one-stop shop wrapper. By integrating Blackstone's private market alternative assets alongside traditional public stocks and bonds managed by Vanguard and Wellington, an individual investor can buy one single fund ticker.
Oh, wow. So just one ticker symbol.
Inside that fund, you get the liquidity of public equities combined with the yield of private credit. It is the ultimate institutional-grade diversified portfolio, previously only available to the Yale Endowment, now packaged into a single line item on a retail investor's brokerage statement.
That sounds incredible on paper, but I am going to act as the voice of the highly skeptical listener again, because we have to talk about the elephant in the room regarding retail private markets.
Let's do it.
We talk about how great this access is, but private markets lack the fundamental feature that retail investors demand. Instant liquidity.
Yes, liquidity is the big issue.
You can't just open your Robinhood app, hit sell on a private warehouse or a private corporate loan, and have the cash settle in your account 3 seconds later. And this fundamental mismatch in liquidity caused a massive wave of drama recently with one of Blackstone's flagship retail products, their private credit fund known as BCR-ED.
Yes, the BCR-ED situation was a major, unavoidable topic of discussion on this earnings call.
The transcript notes that earlier in the year, BCR-ED saw severely elevated repurchase requests. In plain English, retail investors were panicking and trying to pull their money out of the fund en masse.
Right.
It resulted in net outflows of $1.2 billion for the quarter. But the kicker is, Blackstone actually hit their 5% quarterly limit on redemptions, meaning they slammed the gates shut. They essentially told investors, we can only fulfill about 50% of your withdrawal requests right now. The rest of your money is staying put.
That's the gating mechanism.
So I have to ask, if private credit is such a brilliant, safe asset class, why were so many people trying to pull their money out in a blind panic?
It is a textbook real-time case study in the psychology of retail investing versus institutional investing. And John Gray had to address this head-on with the analysts. He made a very distinct point. The actual on-the-ground performance of the physical loans inside the BCR-ED portfolio hasn't fundamentally cracked at all. The underlying credit metrics are stable. The companies are paying their interest on time, and the fund is delivering strong, consistent, current income yields.
Wait. If the underlying loans are totally fine, and the yield is still paying out, what on earth caused the run on the bank?
The media narrative. John Gray specifically called it noise. Let's look at the macroeconomic context earlier in the year. The Federal Reserve had jacked interest rates up aggressively to fight inflation.
Right.
Private credit loans are typically floating rate, meaning when the Fed raises rates, the interest payments on those loans go up. The financial media started publishing hundreds of articles warning of a massive impending calamity in private credit. The narrative was these mid-sized companies won't be able to afford the higher interest payments, there will be a tidal wave of defaults, and private credit funds will collapse.
Okay, so retail investors read those terrifying headlines on Bloomberg or the Wall Street Journal, they get nervous, they look at their retirement accounts, and they call their financial advisors demanding to pull their money out of BCRD immediately to hide in cash.
Exactly. But here is the mechanical friction. BCR is invested in illiquid, private corporate loans that take years to mature. You cannot instantly liquidate $1 billion of private loans without selling them at a massive distressed discount.
Which would ruin the fund.
It would destroy the value of the fund for the investors who chose to stay. To protect the fund from that kind of fire sale, these retail products have built-in liquidity gates, typically capping withdrawals at 5% of the fund's net asset value per quarter.
But I mentioned the psychology of hitting that gate is terrifying for a retail investor. Like, hi, I want my money. Sorry, you can only have half right now. Well, now I assume the fund is insolvent and I want all of it immediately. It creates a self-fulfilling panic cycle.
It absolutely exacerbates the panic in the short term. But Gray noted on the call that Blackstone has navigated this exact behavioral cycle before with their retail real estate product, Bright.
How does the cycle play out?
The cycle is predictable. The media predicts a macroeconomic calamity. Retail investors panic and request withdrawals. The 5% gates go up. The media writes more negative articles about the gates going up. But then time passes.
A calamity doesn't actually happen.
Right. The mid-market companies in the BCR portfolio cut costs, managed their margins, and continued making their interest payments. The tidal wave of defaults never materialized.
The panic fades.
The fund kept paying its monthly yield. The media found a new crisis to focus on, the noise died down, and investors realized their money was actually performing well. Gray emphasized on the call that while it was early in the third quarter, redemption requests in BCR Ed were already dropping materially. The panic was subsiding because reality outperformed the fearful narrative.
It perfectly highlights the tightrope of democratizing private equity. You are taking sophisticated, long-term, fundamentally illiquid alternative assets and selling them to a retail audience that has been historically conditioned to expect instant T+1 stock market liquidity.
And an audience highly reactive to the news.
Right. Highly reactive to the 24-hour news cycle. Managing that retail psychology is proving to be just as important and just as difficult as managing the underlying financial assets themselves. All right, let's move on. We've spent a lot of time analyzing digital infrastructure, AI, thermodynamics, and private credit mechanics.
There's a lot to cover.
It is. But it is remarkably easy to forget that Blackstone is fundamentally the largest owner of physical commercial real estate in the entire world. And the data they are seeing on the ground right now completely challenges the mainstream doom and gloom narrative we are all being fed about commercial real estate.
Oh, completely. If you rely solely on the mainstream financial press, you would assume commercial real estate is an absolute unmitigated wasteland right now.
Office buildings are empty. Everything's crashing.
Right. The prevailing narrative is entirely negative. High interest rates have destroyed property values. The permanent work from home movement has permanently hollowed out downtowns. And commercial real estate is just a toxic asset class.
But the hard numbers in this Q2 transcript tell a surprisingly different story. Let's look at the logistics sector. The massive warehouses powering e-commerce. This is actually Blackstone's largest exposure in real estate globally.
Yes, logistics is huge for them.
They noted on the call that U.S. leasing activity is not just stable, it is meaningfully re-accelerating. Their specific Link Logistics platform in the U.S. saw leasing volume surge by 26%. Rents are growing and occupancy is tightening.
And that operational strength extends far beyond just warehouses. Look at the hospitality sector. They reported that U.S. hotel RevPAR is up 5% nationally.
RevPAR being revenue per available room, right? The ultimate metric for hotel profitability.
Yes. It means that despite inflation and economic anxiety, people are still traveling, still attending conferences, and still spending money at hotels. But the statistic in the transcript that truly defies conventional wisdom, the one that made analysts pause, is their data on New York office space.
Yes, New York office space. The ultimate poster child for the death of the American office. The transcript explicitly states that New York office vacancies have fallen from 21.5% down to 14.5%.
That is a massive drop.
A massive multi-percentage point recovery in occupancy in the toughest office market in the country.
It is a remarkable data point that completely contradicts the narrative, and the broader financial market is actually starting to sniff this out. John Gray pointed out a really fascinating, highly technical dynamic regarding public markets versus private markets.
What's the dynamic?
He noted that public real estate REITs, the real estate trusts that trade daily on the stock exchange like a normal stock, are currently outperforming the broader S&P 500 index year to date.
Let me stop and unpack the mechanics of that. If the prevailing media sentiment is that real estate is dead, why are public real estate stocks beating the S&P 500? And more importantly, if the public REITs are suddenly doing so well, why have private real estate returns, like the ones Blackstone manages, lagged behind them recently?
You are touching on a classic market mechanism called the lag effect. It has to do with how different markets price information. Public stock markets are highly liquid and hyper forward-looking.
They look ahead.
Right. Investors buy and sell public REIT stocks based not on what the building is worth today, but on what they anticipate the macroeconomic environment will look like 6 to 12 months from now. If the public market anticipates that the Federal Reserve is going to cut interest rates next year, public REIT stocks will surge today in anticipation.
Okay, so public markets price in the future instantly.
Exactly. Private real estate, however, is appraised based on backward-looking data. A private warehouse is valued by an appraiser looking at comparable sales, what similar warehouses sold for over the last 6 months.
So they are looking in the rearview mirror.
Yes. So when market sentiment shifts positively, the public stocks move immediately. The private appraisals take several quarters to catch up, as new transactions finally close at higher prices and get recorded by the appraisers. Blackstone is signaling that the public markets have already turned positive, and their private portfolio evaluations are about to follow suit.
But what is actually driving that positive sentiment? Why is real estate fundamentally recovering?
It comes down to the most fundamental, inescapable law of economics: supply and demand. John Gray explained the mechanism perfectly. What is quietly, structurally rescuing the existing commercial real estate market right now is a dramatic, sharp reduction in new construction.
Walk me through the mechanics of that supply constraint.
Over the past 2 years, interest rates have been incredibly high. Simultaneously, regional banks who traditionally fund the vast majority of local real estate construction loans suffered a massive crisis and pulled back heavily on lending.
Because of the banking failures.
Right. Because capital became so expensive and so scarce, it became mathematically impossible for developers to secure the loans needed to build new warehouses, new hotels, or new office buildings. The pipeline of new supply simply vanished.
So if no one can secure a loan to build a new building, the buildings that already exist become infinitely more valuable by default.
That's exactly.
To translate this into plain English for the listener, the fact that you do not see very many construction cranes operating in your city right now is the exact reason why Blackstone believes their existing real estate empire is about to surge in value.
That is the exact thesis. When the economy continues to grow and logistics companies need more warehouse space, they have no choice but to turn to the existing inventory because there is literally zero new supply coming online.
No other options.
That fierce competition for existing space drives up occupancy rates, which allows landlords to drive up rents, which mathematically drives up the valuation of the building. Blackstone is looking straight past the current noise of high interest rates and seeing a fundamental multi-year supply shortage that will massively benefit their incumbent portfolio.
It's a masterclass in ignoring the waves, hitting the boat, and focusing entirely on the horizon. All right, as we move into the final act of our analysis of this transcript, we need to look at how Blackstone is actually executing in the trenches of the current market.
The day-to-day operations.
Right. How are they buying, selling, and actively transforming the companies they already own? This brings us to a fascinating framework introduced during the Q&A segment, the 3 cities of the M&A market.
An analyst asked John Gray to describe the current state of mergers and acquisitions, particularly in the middle market. And Gray offered a truly brilliant, highly illustrative framework describing the M&A landscape as a tale of 3 cities. It essentially maps out which sectors are predators, which are prey, and which are just hiding in a bunker.
I thought this was the most insightful part of the entire call. Walk us through the geography of these 3 cities.
City number 1 is the AI boomtown. This encompasses the AI infrastructure companies, the data centers, the utility services, electrical equipment manufacturers, the cooling system designers, the entire physical supply chain feeding the artificial intelligence build-out.
Okay, so that's where everyone wants to be.
In this city, the market is white hot. Bids for companies are incredibly high, IPOs are successfully launching, and institutional money is flowing freely. It is the ultimate seller's market.
Okay, City 1 is the gold rush. What is the environment in City 2?
City 2 encompasses the AI unaffected companies. These are traditional, boring, highly stable businesses that aren't fundamentally threatened by artificial intelligence, nor are they hypercharged by it. Think of fast food restaurant chains, basic medical supplies, industrial manufacturing, logistics.
Burgers, bandages, and cardboard boxes.
Exactly. In this second city, the M&A market is remarkably strong and stable. Private equity buyers are very comfortable making large acquisitions here because they can confidently project the cash flows for the next 10 years. And they aren't losing sleep worrying that a software update from Silicon Valley is going to destroy the business model overnight.
Which leaves us with the third city, And this is where the transcript gets incredibly tense and incredibly relevant to a massive portion of our listeners.
City 3 encompasses white-collar services, professional information services, and enterprise software, the SaaS companies. And in this third city, the M&A market is practically frozen solid. Deal activity is severely muted, and the valuation multiples that buyers are willing to pay are dropping rapidly.
Let's dig deep into the mechanics of this freeze. Because for the last decade, enterprise software companies have been the absolute darlings of private equity and venture capital.
Oh, everyone loved SaaS.
They commanded massive valuations because of their 80% profit margins and recurring revenue. Why is the smartest money in the world suddenly terrified to buy them?
Because of massive, paralyzing existential uncertainty. Buyers are terrified of technological obsolescence. Let's walk through a detailed hypothetical to show exactly how this destroys a valuation. Imagine you are a private equity firm. You are looking at acquiring a company called Support Desk Pro.
Okay, Support Desk Pro.
They provide enterprise customer service routing software. They have $100 million in sticky, recurring annual revenue and incredible margins.
2 years ago, a PE firm might pay a 10x revenue multiple for that. They would buy it for $1 billion, assuming that $100 million revenue base will grow steadily by 15% every year for a decade.
Exactly. But today, you are sitting in the investment committee looking at that $1 billion price tag, and you have to ask yourself a terrifying question. Is this entire software platform going to be rendered completely laughably obsolete in 18 months?
Wow.
What happens tomorrow if Anthropic or OpenAI releases a native AI agent that integrates perfectly with enterprise databases, handles customer service routing flawlessly, and costs API users a fraction of a cent per query?
If that happens, Support Desk Pro's massive enterprise clients don't churn to a competitor, they churn to an internal AI wrapper that costs them basically nothing. Support Desk Pro's revenue drops from $100 million to $20 million in 2 years. The PE firm that paid $1 billion for it is entirely wiped out.
Precisely. The core value of that software company was performing a complex routing task. If an AI can suddenly do that task for practically free, the equity value goes to zero. Because of that severe overhang of uncertainty, buyers are hesitating.
That makes total sense.
Even if the target business is performing incredibly well today, the high quotient of future risk is causing buyers to simply step back or demand drastically lower valuations, say 4x revenue instead of 10x, to compensate for the risk of sudden obsolescence.
Let's draw a direct, uncomfortable line to the listener's life here. Because this isn't just about billionaire private equity partners haggling over software valuations in a boardroom. If the smartest, most well-capitalized money in the global economy is hesitating to invest in white-collar service companies because they fear immediate terminal AI disruption, what does that mean for everyday white-collar jobs?
It's a scary thought.
What does that mean for the human beings whose daily jobs consist of processing professional information services? It is an incredibly stark warning that the AI disruption of the knowledge worker isn't hypothetical anymore. The risk is actively being priced into the multi-billion-dollar M&A market right now.
It is a profound structural realization. The capital markets are loudly signaling that the fundamental value of certain types of knowledge work is in flux. But, and this is a crucial pivot in Blackstone's strategy, they aren't just sitting back passively watching this disruption happen.
Right.
They are actively utilizing AI to radically transform the legacy companies they already own. This is the core of their internal value creation strategy.
Right. They aren't just playing defense, they are aggressively playing offense. The transcript highlights two amazing, highly specific examples of Blackstone injecting AI into old school portfolio businesses to completely supercharge their operations. Let's talk about Energy Exemplar first, because the operational mechanics here are mind-blowing.
Energy Exemplar is a highly specialized software company Blackstone owns. They provide simulation software that helps massive utility companies manage and predict the flow of electricity across complex power grids.
Okay.
Historically, operating this software was a highly complex, deeply manual process. It required a user with practically a PhD in electrical engineering to input the variables, and running a single grid simulation would take the computer an entire week to process.
A full 7 days just to run one simulation of the grid?
Yes. But Blackstone deployed their internal portfolio operations team, which is notably led by a former head of AI at McKinsey, to go into Energy Exemplar and fundamentally rebuild the software architecture.
What do they do?
They integrated advanced AI models directly into the simulation platform. The result is staggering. That same complex simulation process has been radically simplified. A standard non-PhD user can now configure it through natural language, and the simulation itself takes hours instead of an entire week.
By injecting AI, they took a clunky, expert-only bottleneck tool and turned it into a high-speed, highly accessible product that instantly makes the software infinitely more valuable, allows the utility companies to run hundreds of scenarios instead of one, and makes the software incredibly sticky for the end user.
Exactly.
But my absolute favorite example from the call wasn't a software company at all. It was Chamberlain.
The garage door company.
Exactly.
Yeah.
Chamberlain makes residential garage door openers. You genuinely could not think of a more boring, legacy, physical, old-world manufacturing business. It is literally a small electrical motor that pulls a metal chain to lift a heavy piece of wood. But what did Blackstone's operations team do with it?
They looked at Chamberlain and realized they didn't just own a motor company, they owned privileged physical access to millions of American homes.
Which is a huge asset.
They pivoted this legacy hardware company into a recurring revenue tech business. They utilized Chamberlain's massive hardware footprint to create what they call a digital doorman business. By integrating smart technology, connectivity, and AI routing, they created a software subscription service for secure, automated package delivery and access control directly into people's garages.
So instead of just selling you a motor once every 15 years, they are charging a recurring fee to digitally manage access to your home.
Exactly. And the financial results of that pivot are incredible. That entirely new AI-enabled digital business line is already generating $40 million in high-margin revenue from absolute scratch. And Blackstone projects, it could grow 10 to 15 times larger over the next 5 years.
From a garage door motor.
They are finding massive digital AI-driven upside hidden deep inside traditional boring manufacturing companies.
It perfectly proves the point that the ultimate winners in the AI age might not just be the flashy software startups in Silicon Valley writing new code. The biggest winners might be the gritty, physical legacy companies that already possess hard physical assets, like access to 50 million American garages or ownership of a major power grid, and simply figure out how to monetize that existing physical footprint using smart AI software.
Precisely. The true alpha, the massive returns of the next decade, will be found by the firms that successfully bridge the digital capabilities of AI with the hard, scarce realities of the physical world.
Okay, let's bring this massive deep dive all the way home. We set out to decode the playbook of this $1.35 trillion juggernaut, and the sheer scale and physical reality of their pivot is just awe-inspiring.
It really is.
Blackstone isn't just making a couple of speculative bets on AI software. They are literally financing the concrete foundation of the new digital economy. They are building the massive gigawatt data centers. They are financing the energy pipelines and the high-voltage grids required to power them. They are investing heavily in the complex, closed-loop, water-free cooling systems required to keep the AI revolution from physically melting down or alienating local communities.
And simultaneously, they are pioneering the financial architecture through their massive alliances with Vanguard and the launch of their stabilized data center REIT to allow everyday retail investors to finally participate in this historic infrastructure build-out.
While also managing their legacy real estate.
All of this is happening while they look at their traditional physical real estate empire and see a quiet, highly profitable, supply-driven recovery forming on the horizon, driven by the fact that high interest rates choked off all new construction.
It is a true masterclass in structural finance, looking past the immediate noise and positioning Capital 3 moves ahead of the broader market. So as we wrap up, we want to leave you, the listener, with a final provocative thought to mull over.
Yeah, this is a big one.
As we've seen mapped out today, the only things truly slowing down the limitless exponential potential of the artificial intelligence revolution are physical, real-world bottlenecks. The sheer amount of generated electricity, the miles of copper wire, the heavy industrial transformers, and the legally entitled dirt required to run these models.
The physical constraints.
Right. If that's true, if the digital world is entirely constrained by the physical world, will the ultimate financial winners of the next decade really be the brilliant software coders writing algorithms in Silicon Valley? Or will the real generational fortunes be made by the old-school utility companies, the concrete pourers, and the gritty infrastructure giants who simply own the power lines and the dirt? Think about that physical reality the next time you ask an AI a question, or simply flip a light switch in your home.